2023年中国经济总体回升向好，预计我们的经济总量 GDP 的增幅在5.2%左右。
我是一名失业7个月的设计师，无赖跑外卖。
你得睡到这来，别哭啊！
In 2023, China faced a year of various long-accumulated economic problems coming to a head. The unemployment rate remained high, salary cuts and layoffs were widespread, the real estate and stock markets experienced a collapse, numerous businesses shut down, and rapid deflation loomed large. The engines of exports, investments, and consumption had all stalled. Yet on January 17th, the Chinese Communist Party, CCP, announced a 5.2% GDP growth for the entire year of 2023, confirming the figure mentioned by Premier Li Qiang the day before at the Davos Forum. However, experts have raised doubts about the authenticity of China's economic growth data. On January 16th, Premier Li Qiang delivered a speech at the World Economic Forum in Davos, Switzerland, stating that China's overall economic situation in 2023 is showing signs of improvement. He projected a GDP growth rate of 5.2%, surpassing the initial target set at the beginning of the year. He emphasized that China is a trustworthy nation that keeps its commitments and that the long-term positive trend of the Chinese economy remains unchanged. He further pledged that China's door to the outside world would only open wider. Economists, business leaders, and the working class alike lack confidence in China's economic prospects. Particularly, private entrepreneurs have seen their confidence plummet. Recently, a woman from Wenzhou, who happens to be from the same hometown as Li Qiang, vented her frustrations on social media about the poor business environment for private enterprises, stating that they are on the brink of collapse. She faced online censorship for criticizing China's economy. This young lady, who looks like a family member of the shoe factory owner, said, "Let me tell you a very cruel truth about Wenzhou now. You may not believe it. Many of our current Wenzhou shoe factory owners are living desperate lives. At this time in previous years, our factory was always the busiest. At the end of the year, it's like bags full of money. But this year is different. It's not that there are no orders this year, but many factories dare not take orders. Like many corporate orders and foreign trade orders, the shoes we make now would be settled 3 months later. What's worse is that there are net 6-month orders. The shoes we make now would not have been paid at all a year ago. But our workers' wages have to be paid, suppliers' payments have to be made, and if water and electricity cannot be paid, the landlord will stop immediately. If you don't pay the rent, they will evict you, so it's really difficult. We can't take big orders now, and we dare not take small orders because the market is so bad now. If we encounter a customer who runs away, we will lose money within a year, all for nothing. Therefore, one step forward is a bottomless abyss, and one step backward is a cliff. We can't advance nor retreat." On January 17th, China's National Bureau of Statistics released the economic data for 2023. The gross domestic product, GDP, exceeded 126 trillion yuan, a 5.2% increase compared to the previous year. The economic increment exceeded 6 trillion yuan, and the per capita GDP steadily increased to over 89,000 yuan, a 5.4% rise from the previous year, excluding the pandemic period. In response, many accused the Chinese National Bureau of Statistics for fabricating data, saying things like, "The Statistics Bureau is bending over backward to come up with these figures. World-class data manipulation. Sometimes I wonder who is supposed to believe these numbers that are supposedly based on the eyes of over 1 billion people. False prosperity, and who can't fabricate these figures? It's deceiving the public." The impressive performance in China's economic report for 2023 did not boost the stock market. On the day of the data release, all 3 major Chinese stock indices fell by over 2%. Approximately 5,050 stocks in the Shanghai and Shenzhen markets experienced declines, with foreign investors divesting a net of 13 billion yuan, or $1.8 million. The Shanghai Composite Index closed at its lowest point in nearly 5 years. Hong Kong's 3 major indices also saw a collective sharp decline, with the Hang Seng Index plummeting by 3.7%, reaching a new low not seen since October 31st, 2022. Since the end of 2023, this index has declined by 11%, with a 27% year-on-year decrease. On January 17th, independent commentator Cai Shen-kun published a commentary on Platform X stating, "The simultaneous decline of the Chinese and Hong Kong stock markets today should be the best counter against the government lies." Cai Shen-kun pointed out that it is well known that the Chinese Communist Party lacks credibility. It has not adhered to its promises regarding the one country, two systems policy in regards to Hong Kong, failed to uphold commitments made when joining the World Trade Organization regarding foreign investment, and has even neglected to respect and protect the fundamental rights of citizens recognized by the United Nations. He sarcastically remarked, "Even fools know that in 2023, China's economy is in turmoil, with real estate companies going bankrupt one after another, and the three engines driving China's economy are rapidly declining. Even tax revenue and household incomes are not spared. The unemployment rate among young people is so high that they dare not announce it. I don't know how they came up with a 5.2% GDP growth figure and who set this tone. If a state council premier, faced with a dire economic situation, intends to get through it with lies, then it will ultimately be self-deception and self-inflicted humiliation." Financial commentator Gu Chunqiu stated, "On January 27th, China's official announcement of GDP growth for 2023 exceeded the CCP's target of 5% from the previous year. This should have been good news for the Chinese stock market, but all Chinese stock markets fell that day. What does this imply? The market simply doesn't trust the figures. Investors have no confidence, especially foreign investors who sold over 100 billion yuan worth of A shares." Many economic experts believe that the CCP's GDP numbers are fabricated, with the actual situation being negative. Professor Xie Tian of the Icahn School of Business at the University of South Carolina in the United States stated, "If we exclude the data fabrication and false reporting by the CCP, China's economy should be in a state of recession. Comparing with the United States, the economic growth rate in the United States is only around 1%. Now it's 1.5%. The unemployment rate in the United States is around 3%, which means a 97% employment rate, supporting a 1% economic growth. In contrast, the Chinese government stopped publishing the unemployment rate for a while because the data was too grim. In June of last year, it reached as high as 21.3%. Due to external pressure, it was recently republished, excluding students. In December of last year, the unemployment rate for the age group of 16 to 24 was 14.5%. This is also false. Researchers at Peking University believe it's close to 47%. With such a high unemployment rate, it's impossible to maintain such a high growth rate when seen with the basic principles of statistics and economics." Professor Xie further pointed out, "If GDP grows by 5%, the original three engines, investment, consumption, and exports, must be able to reach 5% or higher for this to be possible. Chinese people don't have money anymore, so they don't consume. Consumption is decreasing, and people may be saving whatever little money they have. If you calculate China's exports and imports in dollars, they are also declining. The CCP has created the impression that exports and imports are increasing, but now they are calculated in renminbi, and the renminbi is actually depreciating. So with a decline in exports and imports, a decrease in consumption, and the real estate sector collapsing, there is no economic growth point. How can it support such a high growth rate? It's entirely impossible." Taiwanese macroeconomist Wu Jialong believes, "The macroeconomic data officially released by the CCP often contains too much padding, so analyzing GDP growth rates and unemployment data is meaningless, because they themselves don't believe in those numbers." Wu Jialong said, "The data from the Chinese Communist Party is different from the data in the United States and Taiwan. It's determined by the authorities. If you really think it's 5.2%, I'll tell you, the actual state of China's economy is definitely negative. It's in a state of recession." He further stated, "Now we need to use other perspectives and methods to understand some specific aspects of China's economy. For example, in first-tier cities like Shenzhen, Shanghai, Beijing, and Tianjin, we need to look at areas related to people's livelihoods, such as retail, luxury goods counters, tourism, and restaurants, to see the purchasing power. In addition, by cross-referencing unemployment data, consumption data, and savings data, we can see that China's economy is currently declining and has actually entered a state of recession." Economist Yu Weixiong from the UCLA Anderson Forecast Center, who holds a similar view, pointed out in a webinar held in September of last year that the China Real Estate ETF, considered the largest fund in China, experienced a cliff-like decline in 2021, falling by 52% from 2019 to October 2023. Based on the above data, Yu Weixiong concluded that if the data of a 50% drop in property prices is applied to the economic model, it shows that China's current economic situation has actually entered a recession with a GDP of negative 0.9%, indicating negative growth. The UCLA Anderson Forecast Center, based on more credible data and following the development patterns of other major countries, has constructed an economic model to estimate China's economic growth rate. The main data of this model include an annual energy consumption growth rate of 4.4%, a carbon emission growth rate of 3.6%, a trade import and export growth rate of negative 6%, and a housing price change rate of negative 20%. For a long time, international media and economic experts have been skeptical of the economic data officially released by China. Due to the extreme lack of transparency in the Chinese government's operations, various financial and economic analysts have arrived at different figures, with the lowest estimate of China's GDP growth rate being only 1.5%. A retrospective and outlook report on China's economy released by the Eroding Group, a U.S. economic research company, on December 29th of last year, stated that the real growth rate in China for 2023 is estimated to be around 1.5%. This is due to the ongoing contraction of the real estate industry, limited consumer spending, declining trade surplus, and severe financial challenges faced by local governments. After Premier Li Qiang revealed that China's economy grew by 5.2% in 2023, the Eroding Group reposted this report on their X account. In a surprising revelation, Pantheon Macroeconomics, a prominent economic consulting firm, has uncovered discrepancies in China's official fixed asset investment (FAI) data for the previous year. According to their research, the FAI investment amount reported by Chinese authorities is significantly lower, by a staggering 7 trillion Chinese yuan, and the previously announced figures representing a 17% decrease. Experts at this economic consulting firm have described this adjustment as shocking. Carlston Holtz, an economic professor specializing in Chinese statistical data at the Hong Kong University of Science and Technology, has raised concerns about the significant adjustment in FAI data, suggesting that these numbers are highly questionable. Holtz further stated that the 1.5% economic growth figure presented by Eroding Group appears to be more realistic. Holtz pointed out that while the Chinese National Bureau of Statistics cannot force lower-level officials to alter data, the agency's position has become increasingly politicized, putting pressure on statisticians to change statistical methods or completely fabricate data to obtain the figures authorities desire. Gary Clyde Hufbauer, an international trade policy expert at the Peterson Institute for International Economics, expressed skepticism about China's economic growth rate. He stated to Voice of America that a more likely economic growth rate would be between 4 and 4.5%, not the reported 5.2%. In light of insufficient or unclear data, Hufbauer highlighted China's struggling stock market, which reflects negative sentiments from both foreign and domestic investors. Additionally, issues in the real estate market have contributed to these concerns. Despite Premier Li Qiang's efforts to promote China's economy in Switzerland, the international community remains skeptical. Kyle Bass, a U.S. hedge fund manager and founder of Heyman Capital Management, described Li Qiang as a Pinocchio who was lying about China's economic situation. Bass pointed out various challenges faced by China's centrally planned economy over the past year, including a real estate collapse, banking crisis, a youth unemployment rate exceeding 20%, and global capital withdrawals. Former U.S. Secretary of State Mike Pompeo's chief policy advisor, Miles Yu, in an interview with Radio Free Asia, emphasized that confidence in China's economy and government credibility has eroded in the international community. Yu argued that the Chinese government's figures are self-promotional, as they always depict economic growth, even in the most challenging times. Furthermore, the inability to verify these figures and the lack of access for foreign assessment agencies to conduct thorough investigations have added to the skepticism. Yu believes that Li Qiang's statements are unlikely to attract foreign investment, as the focus is on the Chinese government's actions. While Beijing's rhetoric may sound appealing, its systematic pressure on foreign investments is a major concern. Yu suggests that without improvements in the investment environment, more verbal appeals for investment are unlikely to change people's intentions. Since China eased pandemic control measures, the country has not witnessed a sustained economic recovery. Instead, it has faced multiple challenges, including declining exports, a worsening real estate market, surging youth unemployment, and weak consumer spending. The struggling Chinese real estate sector remains a drag on the country's economy. Many large development companies are facing severe financial difficulties, resulting in plummeting property prices. Stimulus policies introduced by China to boost the real estate industry have proven inefficient to reverse the market's decline. Analysts at financial holding company Nomura recently noted, "There are no signs that the fundamentals of the Chinese real estate industry have hit bottom." Previously released data indicated a 17% year-on-year decrease in real estate sales in December 2023. As the Chinese real estate crisis persists, the wealth of many Chinese families is being eroded. Sales of luxury goods, primarily targeted at the middle class, such as new Apple phones, pianos, luxury cars, and watches, have all witnessed a sharp decline. According to overseas economic research institutes, 70% of the assets of China's middle class are tied to real estate, and a 5% drop in property prices would result in the disappearance of 19 trillion yuan. The year-end data for China's economy in 2023 cannot conceal the harsh economic reality. According to the Financial Times, by the end of 2023, 9/10 of the foreign funds that had flowed into the Chinese stock market had been withdrawn, leaving only 30.7 billion Chinese yuan. This reflects the pessimism of global fund managers regarding China's economic prospects. Foreign businesses and investments are increasingly leaving China in favor of overseas markets, and this is widely attributed to the current political environment under the CCP. While Premier Li Qiang emphasizes openness and hopes to attract foreign investment at the Davos Economic Forum, CCP leader Xi Jinping has called for stringent financial regulation, especially regarding systemic risks. Xi's directive calls for strict enforcement in various aspects of financial regulation, market access, prudent supervision, and behavioral oversight. Under such regulatory conditions, it is challenging for anyone to have confidence or expectations regarding China's economy. China expert Wang He, in an article on January 17th, expressed that those who believe in the CCP's narrative and expect China's economy to emerge from its difficulties are likely to be disappointed. Wang cited an example where approximately 400,000 Koreans purchased ELS products, equity-linked securities, linked to the Hong Kong Hang Seng China Enterprises Index with a promise of a 5% return as long as the index did not fall by more than 35%. However, the index plummeted from 12,000 points to over just 5,000 points, resulting in substantial losses for investors.